Alright, hello again. We're moving into Chapter 9 now on reporting and analyzing long-lived assets. And I'm moving to slide 3 of the presentation that outlines the study objectives. So the main focus of this chapter will be on plant assets, but we'll also spend some time on intangible assets as well. Here are the objectives in the organization chart format. This pretty much summarizes what we will cover for both plant assets and intangible assets. This is slide 4, by the way. And moving to slide 5, plant assets are physical in nature, whereas intangible assets are not, except perhaps as evidenced by a document in some cases. Note that we've talked about plant assets before under the heading of property, plant, and equipment, or PP&E. PP&E has the characteristics that are outlined on this slide. Note that that land, although it's included in PP&E, does not have all the same characteristics as other plant and equipment. For instance, land is not depreciated for accounting purposes, even though its market value may depreciate or appreciate over the years of ownership. So again, plant assets have physical substance, they're used in the operations of the business, they're not intended for sale to customers in the normal course of business, and they're expected to provide service to the company for a number of years. It says except for land, but as long as the company owns the land and is using the land, then the land can provide for a number of years also. It just isn't depreciated in the same way the other assets are. Okay, on slide 6, and this is showing us that plant assets are critical to a company's success. Well, as you can see on this slide, many large companies have a significant percentage invested in plant assets, although not all, as seen by Caterpillar and Microsoft in this chart. Moving to slide 7, in determining the cost of plant assets, the cost principle makes the accounting for PP&E very straightforward. As we'll discuss a bit later in more detail, though, cost includes all expenditures needed to not only acquire the asset, but also to make it ready for its intended use, as noted on this slide. It's also important to note that some of these expenditures are simply expenses of the period, while others are to be considered as capital expenditures and therefore are to be included as part of the asset account. We'll get into the specifics of which is which shortly. On slide 8, note the definition of cash equivalent price on this slide. This is important. These measures may need to be used when there is some kind of trade-in or exchange involved in the asset transaction. It's not just strictly a for cash type sale. Slide 9, note the acquisition costs involved with the land account as shown on this slide. There are other associated costs besides just the purchase price, although that is the bulk of the cost. And you'll see these things pop up again: the attorney's fees, the real estate broker's commissions, accrued property taxes. These are normal items that will come up in the purchase of land. On slide 10, here's an example that could come from real life, where we need to determine the total acquisition cost of an asset that is new to the company, but not necessarily new itself. And on slide 11, obviously the cash price is the biggest portion of the asset's cost, but we need to determine which of the other costs should be included in the asset's cost, and which are simply expenses related to the transaction. In this case, each of the costs involved, the net removal cost of the warehouse, the attorney's fees, and the broker's commission, all necessary to purchasing the land, need to be included as well in the cost of the land. So the total cost of the land is $115,000, as shown on the slide. On slide 12, land improvements is a separate category of asset that is associated with land, but unlike the land account, this kind of asset can be depreciated over its useful life, because it has a more discrete and limited useful life. Examples are noted on the slide, such as driveways, parking lots, fences, and so on. In slide 13, on this slide we're looking at buildings and how their costs for accounting purposes are determined. If we buy a building, some of the same costs that we saw for land come into play. Attorney's fees, real estate broker commission, and so forth. If the building is constructed, the cost will include the architect's fees, building permits, and excavation costs, as well as the contract cost of constructing the building. On slide 14, for equipment, determining the cost for accounting purposes means including items necessary to acquire and get the equipment ready for its use. As shown on this slide, this includes, besides the purchase price, sales taxes, freight charges, insurance paid by the buyer, and expenditures involved in assembling, installing, and testing the unit. On slide 15, here's an example of purchasing a truck, a piece of equipment for the business. Note how the motor vehicle license and accident insurance policy are not included in determining the cost of the asset. Why not? Well, they are not costs that are required to get the equipment ready for use as a business asset, such as the sales tax and painting and lettering are. On slide 16, this then is the journal entry to record the purchase of the truck, including the two expense items, the license and insurance, although since the insurance is prepaid, it's initially an asset until it's used, as we've discussed in a previous chapter. On slide 17, in a leasing arrangement, the lessee is the one that is leasing the property or equipment from the lessor, who is the owner of the property or equipment in question. So, as the slide shows, the lessee would show the asset and related liability on the balance sheet for a capital lease. Leases must meet certain criteria to be considered a capital versus an operating lease. I don't believe we'll get any further into that distinction in this course. You should know the advantages of leasing, such as the reduced risk of obsolescence, little or no down payment, and for operating leases, assets and liabilities are not reported, just a lease expense. On slide 18, this vignette discusses the prevalence of leasing in our economy these days. See the response to the question on page 499 of the text, which mentions several of the items on the previous slide that are seen as advantages of leasing. And moving to slide 19, note the definition of depreciation shown on this slide for quiz and exam purposes. Note what depreciation applies to and what it does not apply to, that is, land. Finally, note the rationale behind depreciating fixed assets, that they are depreciable in part because the revenue producing ability of them declines over the asset's useful life, at least in theory. So depreciation is an allocation process, really, of the cost of the asset over time. On slide 20, the three main components in determining the depreciation amount per year are shown on this slide. Most of our coverage will involve the use of the straight line method, which assumes the same depreciation amount is computed for each year until the asset has maxed out its useful life. The salvage value is an important component because the asset should only be depreciated down to its salvage value, if there is one, and not to zero, unless of course there is no estimated salvage value. On slide 21, there are several methods of depreciation allowed for accounting purposes. There are other more accelerated methods allowed for tax purposes that we won't get into here. If you take a tax accounting course, you'll be exposed to these other methods. Declining balance is a method that does front-load a lot of depreciation expense in the earlier years of useful life, based on the way it's calculated. Units of activity, of course, will vary depending on the activity level for any given year. You can see that the straight line is far and away the most common method used. Going to slide 22, here's an example that is shown on page 455 of the text. The first thing we need to do, regardless of the method used, is to compute what's called the depreciable cost. Since the original cost is $13,000, but there is an estimated salvage value of $1,000, the depreciable cost is $13,000 minus $1,000, or $12,000. Next, for the straight line method, we can simply divide the $12,000 depreciable cost by 5, the number of years estimated useful life, to get $2,400 as the annual depreciation expense. As the book explains, we could also compute an annual percentage, in this case 20% or 100% divided by 5, and multiply that times the depreciable cost to get the same $2,400 annual depreciation expense. On slide 23, this slide illustrates how annual depreciation expense using straight line is derived by dividing the number of years of useful life into the depreciable cost, as we just discussed. And on slide 24, this slide shows the computation of straight line depreciation using the annual percentage of 20% times the depreciable cost of $12,000. Same result, $2,400 per year depreciation expense is obtained. On slide 25, in this example, the truck was purchased 3 months into the year. So although the straight line method is used, there needs to be a partial allocation for year 1 and year 6, as shown on the slide, with the 9/12 for year 1 and the 3/12 allocation for year 6. Otherwise, the total depreciation over the useful life is the same as before. On slide 26, along with straight line depreciation, an alternative method is the declining balance method, which is an accelerated way of calculating higher depreciation in earlier years than in later years. To do this, a constant rate is applied to the book value, which is declining each year due to accumulated depreciation, a contra asset account that represents the accumulation of all depreciation expenses to date. And I think at this point we'll leave off at slide 26 for this part of the presentation.